Welcome to this week's podcast. This is Andrew Wilkinson with Interactive Brokers. Joining me, Steve Sosnick, Chief Market Strategist, on a shortened holiday week. How are you, Steve?
I'm doing well, Andrew. I'm looking forward to Thanksgiving. How about yourself?
Likewise. Steve, the markets have had a very rough time last week. It's been a solid start to this week, a big rally Monday. Tuesday's looking kind of middle of the road. What are your thoughts after what was really a heavy week for Wall Street?
Yeah, just to be clear, we're taping this Tuesday morning. What is today, the 25th, just before the open. We're talking pre-market here. Last week was very much of a risk-off mood, and I think you could really chart the turnaround to the comments made by New York Fed President John Williams on Friday. And to a large extent, the stock market has been following the Fed funds probability. When it's not a coincidence in my mind that the last high for the S&P 500 was the date of the last FOMC meeting, when Powell threw cold water on the idea of just rate cuts every meeting for ad infinitum. And the market definitely reassessed, and at worst, we were down in the 30s in terms of percentage. And I'm referring both to CME and Forecast X in terms of the yeses on Forecast X. And pretty much as soon as Williams said his piece, off we went. And it's one thing for various other Fed talking heads to say things. It's tough to keep track of which regional Fed presidents are voting members at any given time, who's a governor. Bottom line is, I've seen it referred to as the troika. You have the Fed chair, Powell, you have the Fed vice chair, and you have the head of the New York Fed, by the way, which alone among regional Fed presidents has a permanent seat at the FOMC. The reason for that is they're the ones who actually do the open market activities that the Federal Open Market Committee is supposed to be doing. His view is certainly arguably second only to the chair. And so if he comes out that way, the market really changed its perception. And so off we went. I do think it's healthier that the market is following Fed funds probabilities, because at least that's more of a fundamental than just following things like coin and other risk assets. I think that it's very clear that the correlation, to my mind, is very clear right now.
Steve, it was a couple of months ago, you raised the question about the volume of intended spending on AI in the decade ahead. Several big companies have announced bond issuance. In fact, according to the Wall Street Journal, since September, Amazon, Alphabet, Meta, and Oracle have issued $90 billion worth, which exceeds the total over the past 40 months. Do you find this AI hyperscaling spend encouraging or discouraging?
Some of each. I do think that we were a little ahead of the game in flagging this. I think it's become more of a mainstream concern. Certainly, I think it's one of the things that Michael Burry of Big Short fame flagged. So I'd like to think that we were early on this one. To me, I'm still forced to reckon with the fact that this whole ecosystem has yet to really show that there are revenues to accompany all this spending. And let me be very clear, Meta, Alphabet, these companies, just Amazon, they just spew cash. These are cash flow generating machines. They make a ton of money. But then you have to ask the question, is the money being spent productively on AI? And is it therefore profitable to borrow against it? There you have this cash flow. They can service the debt. The market ate it all up pretty easily, although spreads did widen. They're starting to differentiate. Oracle is not the cash flow generating machine that the others are. And their debt is rated worse, and their stock and bonds are performing worse. This is something we flagged pretty much from day one, which was their massive sales and is predicated on a big data center build out. The big data center build out is predicated on orders from OpenAI to the tune of like $300 billion. The problem is OpenAI, their revenues this year are projected to be about $20 billion. How are they going to come up with $60 billion a year for 5 years off a base like that? So it's an interesting conundrum. The potential gains are so huge that these companies can't risk being left behind. So they have to spend the money. The problem is, as with any emerging technology, we really don't know how it's going to be monetized, and we really don't know who the winners are going to be.
Mm-hmm.
And yes, I find this concerning in the sense that we can get a lot of there's a lot of good money potentially being spent on good things, but also potentially being spent on bad things. It's very difficult to sort out the winners from the losers. And I think ultimately, whenever you do invest, you have to be concerned with your rate of return. And I think in this AI gold rush, I think we lost sight of the nuts and bolts of that rate of return. And instead of just getting fixated on the giant pot of gold at the end of the rainbow. But again, this is why the companies that have benefited are the ones who are actually collecting the dough, whether that's NVIDIA, and we can talk about the circularity deals there. Broadcom has actually gotten bigger than Meta in recent weeks because of enthusiasm for their chips. I think I first argued for putting Broadcom in the Mag 7 in January of 2024, thereabouts. And the picks and the shovels manufacturers are still the ones making the money in this gold rush. The question is, what is the mine going to yield in the end?
Wise words. We've got Tuesday, Wednesday, half a day Friday, and then next week, when investors come back from Thanksgiving, it's December. Now, you talked about the changing odds on Forecast X for a rate cut, thanks to comments from John Williams at the New York Fed and now Christopher Waller. I'm just getting the sense that there is going to be a rate cut a couple of weeks' time from now. What does your gut instinct tell us about the pattern for December trading, given it's just around the corner?
It really depends as to institutional investors' desire to either lock in profits or rev up into the year end. One thing about this week that's really a little bit odd is we have a month end on a half day, which can lead to some very interesting market dynamics. I've written about the idea of not cooking the books, the idea of position, window dressing. Sorry, I was grasping for that word. Some readers have written in the comments, no, that doesn't happen. I will tell you with perfect assurance from when I worked on the sell side specifically, I'm on the sell side again, but when I dealt with a lot of this stuff directly, these institutions directly, they do it. They do it at the end of the month. They do it at the end of the quarter. They do it at the end of the year. It happens. There's too much money riding on this stuff for this to happen. But I don't know. So I don't know to what direction, though, the window dressing will be, because November has been a lousy month. I don't want to write off Friday. It has the potential to be a very
exciting,
unique afternoon, say.
Right.
But yeah, we're already definitely getting into pre-holiday mode. As for once we get into December, I think we'll have to do. Really, the tone for the month will be set on December 10th, when Chairman Powell rolls out there and says, here's what I see for interest rates. I think it'll be very interesting to see the tone that comes out of the Fed. I think, by the way, not a self plug for our platform, the most exciting contract in my mind is the dissent contract. We actually have a contract on Forecast X for the number of dissenters. We actually have two contracts. So it's a little tricky to find sometimes, because there's one contract that's just, will there be dissent or not? That's about, I think it's 97% yes. It's pretty clear that there will be. But then there's another contract that is number of dissenters. And right now, that number is basically kind of 50-50-ish around the 3 number. It's 43, 55, 43 yes, 55 no. It's a wider spread than I'd like to see. But the point being, we're seeing markets centered around 3. And I think that's an interesting one to keep an eye on, and possibly an interesting one to trade around, because no matter how you slice it, there's going to be someone unhappy at this Fed meeting among the various voting members. And even Stephen Myron, which is basically alluded to this, which is one of the other things that sort of pushed up the yes percentage for a cut, was him saying, all right, I'm not going to, yes, I really want 50, but if it's a choice of getting 25 or 0, I'm going to vote 25.
Yes, but so far he's been a dissenting vote for the last 2 meetings, because he's wanted 50. So he's voted against 25 and in favor of 50. So he'll be dissenting again. Which
is a change in tune. So he says here's the weird part. If there's a consensus to do 25, he's going to dissent and say, I want 50.
Yeah.
If it's really a coin flip as to whether we're going to get 25 or 50, 0 or 25, he's going to vote 25. On the understandable theory, a half a loaf is better than none at all, because you can actually have up to 5 dissenters. It's a 12-person board. And so 7 to 5, you need 7 yeses. So the question is, how do you get to yes? I think what it does tell us is that we're in for a little more exciting times, because I think with with it being evident that Powell's term is over. I don't want to use the term lame duck because that makes it sound like he's just phoning it in. He's really, I have no reason to believe he's doing that. But I think there are different, political motivations. We know that Governor Waller is actively lobbying for the job, as is Michelle Bowman. So although Waller basically said yes, 25, but unclear about what goes forward. So I don't recall a situation where there's that many moving parts. And quite frankly, the Wall Street Journal had a story today or yesterday about how rare it is to get this potential level of dissent.
And don't forget, you can check out I think the nominations is also listed as a contract on ForecastX, Steve.
Yes, I forgot about that. Yes.
Yeah.
Shameless plug division. Yes, we need.
That's how us former traders like to think.
Exactly.
All right, Steve, thank you very much for your time today. And don't forget to the listener, if you enjoyed today's session, you can subscribe wherever you download your podcast from. Thanks, Steve.
Thanks, Andrew. Take care. Happy Thanksgiving.
And to you.
Thanks.
Bye for all.
The analysis in this material is provided for information only and is not and should not be construed as an offer to sell or the solicitation of an offer to buy any security. To the extent that this material discusses general market activity, industry, or sector trends, or other broad-based economic or political conditions, it should not be construed as research or investment advice. To the extent that it includes references to specific securities, commodities, currencies, or other instruments, those references do not constitute a recommendation by IBKR to buy, sell, or hold such investments. This material does not and is not intended to take into account the particular financial conditions, investment objectives, or requirements of individual customers. Before acting on this material, you should consider whether it is suitable for your particular circumstances, and, as necessary, seek professional advice. Trading in digital assets, including cryptocurrencies, is especially risky and is only for individuals with a high risk tolerance and the financial ability to sustain losses. Eligibility to trade in digital asset products may vary based on jurisdiction. Interactive Brokers LLC is a CFTC-registered Futures Commission merchant and a clearing member and affiliate of ForecastX LLC. ForecastX is a CFTC-registered designated contract market and derivatives clearing organization. Interactive Brokers LLC provides access to ForecastX forecast contracts for eligible customers. Interactive Brokers LLC does not make recommendations with respect to any products available on its platform, including those offered by ForecastX. Forecast contracts are only available to eligible clients of Interactive Brokers LLC, Interactive Brokers Canada Inc., Interactive Brokers Hong Kong Limited, Interactive Brokers Ireland Limited, and Interactive Brokers Singapore Pty Ltd. Forecast contracts on U.S. election results are only available to eligible U.S. residents. Futures, event contracts, and forecast contracts are not suitable for all investors. Before trading these products, please read the CFTC risk disclosure. For a copy, visit our warnings and disclosures page. Displayed outcome information is based on current market sentiment from ForecastX LLC, an affiliate of IB LLC. Current market sentiment for contracts may be viewed at ForecastX at https://forecasttrader.interactivebrokers.com/ian/home.php.
This is commentary on economic, political, and/or market conditions within the meaning of CFTC Regulation 1.71 and is not meant to provide sufficient information upon which to base a decision to enter into a derivatives transaction.